Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. Past guests include Devin Howland talking about the economic development situation in Fayetteville, Arkansas, Yoni Schmidt of the Keyrenter team talking about property owners' frequently asked questions, and Kevin Evans of Liberty Air Services talking about HVAC systems, how they work, and why they're super, super complicated. I remember him talking about holes in copper lines just real quick and being like, why are there multiple holes in copper lines? After you fix one, another one pops up. And he's like, yo, there's hot and cold gas and liquids running through these things for 15 years and they just wear out. And I was like, oh, that's a really good point. But our owners often don't understand that. And the solution can be to just buy a new system, which will last you for another 10 or 15 years, 20 years. And Cain, I'm happy to have you talk about that because that's generally how you reposition your property. So I love it. Today's episode is brought to you by Chris Lyle State Farm. Chris Lyle State Farm helps you protect your most precious assets and investments, whether it's your home and auto, investment rental properties, or other valuables. Call Chris Lyle State Farm for a quick and painless phone call to potentially save you double digits on your insurance needs. Visit diallyle.com. That's diallile.com. Or call his office at 918-878-7771. This episode is also brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Listen, Cain, you know as well as anybody, it's hard to line up contractors to get make-readies done in a reasonable amount of time if you don't have the scale that Wright Property Group has. Contractors are busy. The work seems to drag on forever, and all of this leads to lost rental income. I don't know anybody better that knows it more viscerally than you would, and I do. So it's a very painful process. But at Keyrenter, we line up our dedicated vendors so that unit turns can happen super quickly and we get more money back into the pockets of our owners. That's why no matter what rentals you have, single family homes, condos, townhomes, apartments, we've got the management solutions you need. Go to KeyrenterPMC.com or info@KeyrenterPMC.com. A huge shout out to Jesse Hancock on our team at Keyrenter for introducing us to Cain Wright, our guest today. Jesse's not only been an awesome property manager, but he's got tons of people in his Tulsa network, and he's been an investor-friendly agent forever and just, has it going on, knows the community. So we appreciate Jesse forever and ever. Let's introduce Cain Wright. Cain Wright's a multifamily and single-family investor based in Tulsa. His group owns approximately 100 doors, focusing on renovating and repositioning complexes. And if you just do a quick Google search for white oaks and black oaks, you'll see what that really means. A lot of people think they're doing it, but Cain's team is really, really doing it. Wright Property Group also flips homes, and they carry a real estate license. Professionally, Cain is a senior vice president at Grand Bank with a focus on investment lending. Welcome, Cain, to the show. We appreciate you being here.
Yeah, thank you for having me.
You look dapper as always. I was with you yesterday for a walkthrough of a new, of an unfinished building that is going to be a hotel called the Brute downtown, which looks, it's 16th and Boulder. It's super awesome. Yeah, I was dressed like a contractor. You were dressed like a gentleman. So I appreciate that about you. Tell us a little bit. Tell us how you got started in the real estate investing game. You got a big portfolio, but it has to start at some point. For our listeners that don't own anything, or maybe on something small and want to get to your scale, tell us how it happened for you.
Yeah. It's certainly been an evolution. So, I have my undergraduate degrees in finance. I thought I was going to be a traditional investment broker. I came from a very humble background, so didn't have a lot of support. So I needed to work immediately when I graduated. So I had interned with a bank. I had one semester left. They offered me a full-time position after graduation. So, I accepted. I graduated and started the next week. They kind of threw me right into the fire in lending. So I knew finance, but I didn't understand, real estate investment, anything. Just started working with different clients. And then I think really at that time I was, looking at all these wealth methodologies and how to generate and create this generational wealth. And especially it was vital to me at such an early age, just coming from poverty. So it's like, I want to break this. I understand, I'm reading all the books that you hear all the time, right? So Rich Dad, Poor Dad,
right.
Think and Grow Rich, everything. And I'm just absorbing it all. And I get an opportunity to work with an investor who ultimately became a mentor to me, who I still is a good friend today. So
Who's that?
so his name is Jeff Clay.
Great.
It's interesting because real estate investor, but focuses on retail like strip mall.
Awesome.
So not something that I do, but
I don't know anything about that world either. Super interesting. Love to have him on.
Yeah, so we look at the first opportunity. He's buying a 30-unit strip mall. It's 50% occupied, and it was one of those situations where a big corporate office had bought the neighboring building, and then this whole strip center just kind of came with it. So they weren't really maximizing potential. It wasn't their philosophy. It was kind of a throw-in. So he brings this opportunity to us, and he buys it like 700,000 or something. This is probably 2012, right?
Wow.
So I'm still in this, like, I'm working on the lending side and keeping that professional, but then I'm like taking notes on the side of like, okay, how do we like, so we look at his financials. He's got a great proof of concept. Everything's there. The property can actually break even with just the 50%. So we're like, okay, we like all that. And then I remember at that time, you have to think, coming from poverty, like $200 was a lot to me.
Sure.
So I'm like, I'm going to tell this guy that we can do it, but we've got to have like 150,000 down. And to me, that was like asinine. I was like,
sure.
Well, I mean, what are you going to, how, where
might as well have been $1 billion.
Right.
Yeah.
Yeah. So, we sit down, I explain that to him. He pulls out a portfolio, like a 3-ring binder. And he's got like 10 houses. And he's like, hey, I own all these free and clear. Just take whichever couple you need.
Wow.
And I'm like, well, that makes sense. So I'm like, okay. So we end up essentially funding it. He uses 2 properties as collateral. So the bank's well positioned. And then over the course of the next 12 months, I watch him finish and fully stabilize that asset. And so there are different fundamentals in multifamily, but overall it's income based, right?
Right.
So he takes that, does a 2.5 time increase to rents, then gets it reassessed. It's now worth 1.3. He says, hey, I don't need to recap or cash out. Just release those 2 houses. We do it. And then I left that bank. That was the first bank I was at. I left. I called him the first day at the new bank, not to solicit business. We went to lunch. I said, like, I need to understand how you did this. Right. So basically fast forward, like just seeing it, I think. And like, I had identified that obviously, you're either investing in the market, creating a business, or acquiring real estate. Those were the 3 methodologies, right? At a very high level. And I had really started to understand, to me, the real estate method made the most sense because you could lever, right, other people's money.
Sure.
So I was kind of pushed down that path as all of this was unfolding. So then, yeah, man, we connected, we stayed connected. Like 3 months later, I bought my first house as a first-time home buyer. It's interesting because it was kind of a house hack. Like I rented the other room out to a roommate, but it was before like bigger pockets or anything. So this is like, it wasn't a definition. Like I just was like, hey,
you're just hustling back then.
I remember, man, it's baffling to me because I'm 33 now. I was 22, almost 23 at the time. And I had to negotiate the earnest from 1,000 to 500 because I didn't have 1,000.
Wow.
It was some first time home buyer program. So I get a fully escrowed mortgage. I get my earnest back at close. Fully escrowed mortgage is like $625. I rent one of the rooms out for $450. So I'm living for $150. Like 12 months later, buy another one. That one turns into a rental, and I owned that for several years before we sold. So that was really the kind of the launching point.
So Jeff Clay was your initial inspiration for real estate. You chose the residential path. He was on the retail path. But I want to ask before you go on, and I want to hear the rest of the story. I want to understand. You say growing up in poverty. What did you understand about building wealth when you were a kid? What was your perception of it? I mean, I like what you said earlier. $150,000. It was just it was an astronomical sum. So you came from a place where that was just kind of unheard of, or was the thing of dreams or whatever. Like, what did you understand about building wealth? Was it perceived as an evil thing, as a great thing? Was it just something that we don't do in our family? Like, what was your initial bias coming from your family?
Yeah. No, I think it's twofold. I think one of it is a mentality. It's more of a poverty mentality. Not
And
that wealth is evil, right? But more just thinking in terms of this very conservative methodology, stay the course. And so I'm the oldest of my siblings. My mother was 19. My father's been incarcerated most of my life, so we don't talk. We went through bankruptcy. We were on housing assistance, and I was the oldest, right? So my mother is actually a great success story, because then she, became an RN at 20. I have two younger siblings. My brother's father was awful as well. So we kind of went through that, and I was the oldest, so I saw it all, right? So I was very cognizant of it at an early age, of like what financial strain can do.
Right.
So I think I wasn't quite thinking in terms of building generational wealth yet. I just knew that when I was older, I wanted to not be broke. That was like in my head. I was like,
that's a powerful motivator.
A lot of problems.
Yeah, for sure.
Yeah. So I think as I started like professional career in my early 20s, really the emphasis was money, right? And then as you mature and you start to get exposure, and I've always said, like, once you stretch your mind and see other things, you can't unsee it, right? Like once you see this guy do this with this type of asset, like it's seared in your brain. So I think the big facet there for me is just like seeing it all. It went from, hey, I just want wealth, to like, hey, I want a legacy. Wealth is it's a leg on that chair, but there's other facets, right? So it's kind of evolved. So I think just seeing it, being cognizant of it, looking at the issues, and then because my mother just worked really hard and then started to have some success later on, I also saw a very calculated, like, conservative approach of like, work for one company, be loyal, do these things, like, don't take these additional risks, because she didn't have the latitude to be able to do that. Right. And I was always the type, I always think that if there was any value in, like, I always said, like, my father's side and all of them were outlaws. And I feel like if there's anything that I took from that in a positive, it's like I question things. And it's like, well, like, why do we have to do it this way?
That's your entrepreneurial spirit.
Yeah. You're like, so like, I'm reading all this, and it's like, okay, so I can work for somebody else. Okay, that's fine. I mean, I still work in a corporate setting, right?
Yeah.
So I'm going to work for somebody else statistically till I'm 55 to 60, if we don't have some sort of 2008 cycle that happens right before I retire, and then I'll statistically die 6 years later. I was like, guys, this sounds awful. Like, I don't really want that. And like, why do we have to do this? So I think that was, it caused me to question, and it's just that mentality, and I understand why she had it, because she also came from nothing, and she had carved out a better path over the course of time using that conservative method. To me, it just wasn't, I didn't fit in that box.
I mean, in a sense, it reminds me of the old expression that necessity is the mother of ingenuity. And it's, if you have that hunger for more at an early age, it inspires in you. It ignites a flame that does not burn out. It's just like, I want to build something that I didn't have as a kid. So in a sense, I mean, we think in our world, we think of people that are, born with a silver spoon or born on third base as having the blessings, but it's like, the blessings that you receive from just having that internal motivation to just run and go is, I think, not without its significant merits. Okay. So sorry, I cut you off.
No, you're good.
Let's talk. So you bought your second house. So you had your first house. You were still living in it. You were house hacking it before it was called house hacking. And then you bought your second house as a pure investment property. And how did you kind of scrape together the cash for the down payment? How did you find the deal? What did it look like? Tell us about the numbers.
Yeah, it's crazy, man. So it was actually the house next door. And it was a single family house. The
neighbor came to you one day and was like, I'm selling, or what? How did you just knock on the door?
So we buy that house, right? Next door, it's an elderly lady. So I met her, I would periodically, like, if she needed help with stuff, kind of help out, just trying to be friendly. Wasn't calculated, playing chess or anything. I was just being nice, right? And then it turns out, like, a year later, I meet her son-in-law, who happens to be a very successful businessman in Tulsa. And he had bought that for her, renovated it, And then she had gotten to a point where she was going to have to get transitioned to assisted facility.
Yeah.
And this is where I think the power of like speaking those visions and not holding them back, because I remember meeting him and I was like, hey, I really admire what you've done. Like, here's some of my, like, this is what I'm going to do. Right. And at this point I have one house, right? So
Sure. But you know, you're going to have 100.
Really an investment. Yeah. I know it. Like, I see it, you know, I see that, I can visualize it. And so we were just having this passive conversation. So then, you know, basically I'd been in that house a year. His mother has to transition to an assisted facility. He comes to me and says, hey, I know you want to buy investment properties. I know this one's going to eventually be a rental. He's like, if I sell this, I'm just going to get hit with capital gains. Would you want to buy it from me? And I was like planning our wedding at the time. Wow. Like I had barely had enough like to buy this first one. So I said, hey, I'd love to do that, but you know, I'd have to go try to get the financing. Like, I can figure it out. I just might need some time. He's like, well, I don't want to pay it off anyway. It's owned free and clear. Why don't you tell me a price? If we can agree on the price, you tell me what you can pay down.
Wow.
And then I'll carry it. So it was a traditional like owner carry. I put $5,000 down that I borrowed from like a peer-to-peer lender, right? Wow. Which it's funny now because, you know, I'm obviously on the lending side. So like, I don't advise this from like a lending capacity. It's like what I did. Like, some people are going to do it no matter what. And I respect that. And if you're going to do it, I'll tell you the best way to do it. But then I always have to have that balance on the lending side of like, yeah, technically being fully levered with no additional reserves is not the best thing. But I was going to do it, you know, no matter what. And I didn't have anything. So for me, it's like, what's the issue if I fail? I'm back to nothing.
Yeah.
So I put that, he puts it on a 20-year at like 5.5%, bought a house in Broken Arrow. It was next door for like $85,000. It was so awesome too, because we were under contract. He was letting me show it for like leasing.
What an ideal scenario.
Yeah. Oh yeah, man. And that's where I do think, side philosophical note, I think, you know, it's like we create our own luck, right? Because I was intentional about conversations. I had that visualization of it. I had spoken that to him. It's like, yes, it was a very lucky opportunity, but it came about because of that dialogue and the things that happened, right? So yeah, man, I had procured a tenant before I even closed. I closed with him. It's funny because, you know, I mentioned this to you when we spoke. I had recently started piecing off the singles. So I had owned those for the last 8 years. And then last year I sold both of those. I still had the same tenant that
wow, I
procured there like 8 years ago.
So, I mean, I think the story highlights a couple of different things. Super, the intentional way that you were living life. It speaks to the integrity that you were living with. I mean, not only helping your neighbor, which is a
right,
you know, a great thing in life in general, and a great way to be, but just, you know, living with integrity. And the guy knew it. He just looked at you and knew it, and he respected you and was willing to take risk on his part to carry the note.
Right.
And you know, he understood that you could default at some point. I don't know if he knew you were doing peer-to-peer lending to get the 5,000, but either way, he thought, look, I'll take a risk on this kid because he seems like a good guy. So that's number one. I want to ask you, number two, like, what was his business? How did he make it so that he didn't really care? He wasn't, you know, he didn't need the cash right now, because that's a great position to be in. The best time to buy real estate, or the best time to negotiate any deals, when you're like, look, I could use it, I could not, you know, it would help me out, but I don't need to, you know, my kids aren't going to starve if I don't do this, which seems like he was in that position. What was his business?
Yeah. And he owned like a couple machine and fabrication companies. I think it was like at some point decades ago, it was his father's, and they, you know, it was just a mom and pop. So he had he had scaled it, lived in Broken Arrow. You know, he was at the point where he was at, you know, probably at that time in his late 50s and 60s. So he was kind of transitioning out to more of a board role, like his children were taking it over. So he had created that wealth for himself. You know, I think this was like an ancillary thing for him, and he didn't want to sell it. And I think the big thing that he saw too was like, when we had those conversations, and I always tell like younger investors this, like, I'm not a fake it till you make it guy, right? Like, I'll tell you, like, from the beginning, I believed that I would do that, but I was always I had the humility to say, like, yes, I'm going to get here. This is what I have now. And I think there's a respect in that. And you know how investors are, there's always a willingness to have those conversations. And when you see, I feel like I've had a few of those investors, like the first one I alluded to, and then him as well, even though he's, you know, more of an entrepreneur than maybe a pure investor, but they kind of see that, they see themselves in you, right? Like, okay, I know that feeling. Like, I was that guy too. So it's like, we still had to hash out terms and it be a competitive deal, but it was like, he's like, hey, this works for me and it works for him and I like him,
Yeah.
and so it just worked out perfect.
I was telling you before, we sold an apartment complex to a gentleman back in February, and we actually had dinner last night. And I just love, there's this thing in negotiation that, sometimes you want to take every chip off the table. It's like, it's a zero sum game and I've got to get mine so that the other person loses. And I love this story. And I love, frankly, selling Kelly apartments, because when you can have a transaction, a negotiation where everybody wins and you're still friends afterwards, and you weren't hiding anything, you weren't lying about anything. It's just I just love that win-win perspective.
Yeah.
And I think in real estate, there's really a great opportunity for that. Sometimes you reposition, you guys don't do this, but sometimes you reposition a property, you do 10 of them of 20, and you say, look, I've done the proof of concept. Right. Now I can sell it based on that proof of concept and let somebody else take a little bit of the meat and cash in on that, on the additional 10 renovations, do the work, and ultimately, cash flow it better or do whatever else. Yeah. I don't know how many industries, I guess you can sell a business and that can be the same way. And in fact, we did an acquisition in Arkansas recently, and it was that, we retained the people that sold us their business, and now they're part of our team, and we love them and they love us. It's just a great feeling to have a transaction like that, where the gentleman sells you his house, his mother's house, and you win and he wins, and he feels good about helping you build something. And, you can still be friends afterwards. I just love that. I love that story.
No, I agree 100%. And I think it's been awesome because throughout the whole single family kind of phase and duration, even into multifamily, I can only name one scenario that we just didn't have an excellent rapport with the buyer or the seller. And, it was one of our multifamilies, and it was kind of broker led it. And I think it was more kind of ego on the seller side of letting it go for what it was. But every other transaction, just as you've alluded to, like it's been mutually beneficial and very transparent. And I like you do, it's like you leave and you feel so much better. And I agree. It's like, man, there's ways that everybody can win. It doesn't have to be a zero sum game.
Yeah. It actually also reminds me of Kelly Apartments. When we bought it back in 2018, we bought it from David Sharp. Brian Elliott's his right-hand man. They still work together. In fact, they are doing the Brute Hotel that we saw yesterday. And I remember working with Brian on the contract. He told me, hey, there's this thing, we're trying to get rid of it. I walked it. I said, we'll do it. I put a contract together. And then ultimately on the financing side, we hit like delay after delay after delay. And every time I went to him and I said, Brian, and of course, I think as a caveat, you have to say, in the seller's position, you're always at the greatest risk, because somebody that doesn't perform on the contract can tie up your deed for a long time and do all sorts of nasty stuff. Realistically, they can put a mark on it, a demerit on your property, on your deed for 10 years, and then you can't sell it against. It can be nasty, which is why having lawyers review your multifamily contracts is a really important thing. But I kept saying, Brian, I'm sorry, this is a delay. And I felt like coming to him with this request for additional time was going to be a big deal, and he was going to question my integrity and whether I actually intended to close. And every time I went to him, I think we extended twice. Every time I went to him, he goes, yeah, cool, send the extension documents. I'll sign them. No big deal. Yeah. I was like, Brian, not only do I love Brian to this day, who's just a great person, a great business person. And I just love that he works with David Sharp, but it's just a good feeling to know that somebody's treating you like you have the integrity that you actually have. So, I didn't intend for this to be like such a feel-good podcast about life and integrity. Okay, cool. So you do that house, and tell us how you scaled. Like ultimately, you moved to some big properties. You bought South Boston. You bought Black Oaks, White Oaks. Now you've got this thing in Kendall Whittier. Like, let's jump ahead a little bit and tell us how you ultimately scaled to be able to buy these big multifamilies.
Yeah. So we continued on that path. I always feel like the first 4 to 5 are the most difficult, right? So as you get the traction, you get the reps, you start to understand it more. We started to build some equity. I was growing professionally, and then it was time to, at that point, really gravitate. In my view, I still love the single family model. I still do a few flips a year, but it was just an economies of scale thing. So I had kind of developed this philosophy on single family of, to some degree, a path of progress investor, right? So we discussed this a little bit, but I don't speculate on values, but I buy in areas that I don't want to be the pioneer. I don't want to be the first guy there. But as I start to see traction in certain revitalization and components to where I can justify a strong recaptured equity position at the time of when I'm finished, but I still anticipate some escalated appreciation because of the fundamentals of that area. That's what I started pursuing. So I kind of gravitated that model to multifamily, which can be a little tougher just because there's simply not as many, right?
Sure.
There's not as many multifamily,
and it's a competitive space,
but
super competitive space.
It is. It's different. So I really started, looking and there's some overlap with single family, but it's also different in terms of your end buyer, the model, how you derive values. So, really just started looking at the multifamily. Actually, it's interesting. My first multifamily acquisition was out of market. It's the only thing I've owned out of this market. It was a 48 unit in Stillwater. Wow. So I had familiarity with the area. It was right next to campus. It was a very poor performing property. So, I had read all the books. I've done single family now. I know this stuff, right? So we get into it. Ultimately, a lot of learning there. Tertiary market, different management components, different drivers. But we acquired Wright, which to me, as you know, is always the rule with the real estate. Like you buy in a way that you have some latitude and grace, right? So reposition that over a couple of years, learned about everything in terms of repositioning, going through that process, managing it even from afar, which was difficult because I'm pretty hands-on.
Yeah.
So ultimately sold that to an investor that had more scale there, kind of as you alluded to in your example, where we had kind of taken it to 90%, but he got to take it home. He had the scale to do it. It worked out beautifully. And then I said, okay, now I've been through this. I really understand it. I'm going to push this in my market. And then that's where Boston comes, and then Black Oaks follows that. And then just
Did you exchange out of that sale into Boston, or did you just take the cash and
we took the cash? Yeah. We took the cash.
I want to go back real quick to one thing you said. You don't bank on the appreciation, meaning you're not a speculator. You move through the path of progress. So you want to make sure that the property cash flows based on what's happening right now, and it will continue to cash flow. In case you hold it for 10 years, you want to make sure it continues to be a good investment. If there is upside, and sometimes you hope that there's upside because you're buying in the right areas, but if there is upside and it turns out that you sell it as a stabilized asset, then great, you've got some gravy on top. But if you have to hold it for a decade, you know that it's going to perform in the current situation, in the current neighborhood. If nothing else changes, etc., you're stable and good the way it is. Is that right?
That's it. I analyzed it just like that. Like, if nothing else happens in this market based on the economics today, in very simple terms, once I'm repositioned, this is still a double. Like, I'm still hitting a double here.
Right.
I anticipate because of the economics and what's happening, but those are things that I can't control, right? So I can live with that double all day. Now, if it does what I believe it will do, now I'm hitting a home run, right?
Right.
But if it doesn't, my fundamentals work, and I'm not dependent on external forces. And that's always been my philosophy with real estate. Like, I'm a finance guy, but I don't even look at the market every day like other people. And like maybe I should even more, but it's like my philosophy has never been dictated on market. Yes, those things can have an effect. They can, rents change, things like that. But I model it in such a way that it's like, I don't care if rates go to 8%, this still works. I don't care if, this traction in this particular area doesn't continue at the pace that it has, so be it. I can live with that. And if I can live with that, then I know the rest is just upside, and I have no concern. And yet,
you perform very conservatively, as you're saying, and you've outperformed rents on almost every property you've ever done.
Yeah.
So, I mean, do you look at the model, you're like underwriting this thing and you're like, ooh, you start getting like giddy. You go, ooh, I can, you start sensitizing. You're like, if I push rents from 1,100 to 1,150, your IRR, you're, assuming some exit, your IRR goes boom and skyrockets, and you just start getting giddy. I love that. I love that part of underwriting.
Yeah. So it is so funny because it's, as Sam got into more multifamily with me, I told him, I was like, hey, when we do an initial analysis and underwriting on a property, you're going to see two samples from me. One is my base case model that I feel extraordinarily confident in, that I'd say over 7 to 8 multifamily acquisitions, I've exceeded that every time from both, an income and expense side. So, twofold, right? Yeah. And then you're going to see what I believe we can take it to. And also, so that's my legitimate pro forma. I just don't need that. And then so the other one's more of like my base case scenario. So, but then obviously I'm, my actual what I believe it will do, which they typically perform at. That's what I'm making sure. Like if I'm getting financing, like that's what I'm going to use for the bank because and it's not. I don't want that to be misconstrued as like disingenuous. It's really just like I have a conservative methodology that I know that, hey, if this is all that happens, I feel 100% confident and I can live with that. Here's what I really think it'll do. That's what I want to be utilized for my actual pro forma analysis from a financial standpoint, from appraisal standpoints and whatnot.
So the difference between your base case and your upside is the difference between putting in granite versus Formica, putting in a stackable in the closet, not dishwasher, not. How do you know for any given neighborhood or any given property to what extent you want to take that renovation? Because a lot of people, I see people putting, just the craziest things, granite and backsplashes into 54th Street North, and I think I don't necessarily agree that neighborhood is going to command the rent for such a top-notch product. How do you know kind of what extent you should take a reno to?
So it's interesting. I completely agree with you. And I've, working with so many investors, you see so many different methodologies, right?
Yeah.
And I think it's very vital as an investor that you tailor your investment journey to two things, right? To what fits you, what you do well, what you like to do, and then to your overall goal, right? So I think those two things are important. So for me, and I think this goes back to like growing up, in poverty and renting from slumlords. I just felt from the very beginning that like I will never acquire something that when I'm done with it, I'm not confident putting my name on and I'm not comfortable with my family being in. So because of that, my model does not allow me to buy in certain areas because I don't think it commands it either. So even if somebody brought me some asinine 3-to-1 opportunity of a 100-unit deal, if I didn't feel like I could take that to where like to that quality level that it's a non-negotiable for me, I just can't pursue that. So when I talk about my base case and pro forma, usually my quality and what I'm going to do to the property don't change.
Right.
I'm just running it and saying like, hey, like Black Oaks is a great example. Like I know with 100% confidence, I can take this to 875 to 895 rents. I don't care what happens. Like, I don't care what the effects of COVID are. I don't care. I know that I can with the quality that I'm going to bring. I really anticipate it to do more, right?
Sure.
But my quality doesn't sacrifice. But I agree with you. There are certain models where it's like, I can't, even if it was a great opportunity, but it doesn't command that. And I have a value. That's just my preferred methodology, right? And some people would say like cash flow buyer, that makes more sense, right? Well, it does for you. It just doesn't for me.
When I look at your projects, and again, Bostonian, White Oaks, Black Oaks, you're doing aesthetically among the nicest work that I've seen in Tulsa. My question to you, where does that come from? Like, who's doing the architectural plans? Who's helping you think? Like at the Bostonian, for example, you took a 2-bed and made it a 1-bed because you didn't think that the kitchen was aesthetically pleasing enough. It was a tiny galley kitchen when you started.
Yeah.
I know because we used to manage that property. We did the best we could. The former owner didn't really want to do a ton of work. And I always encouraged him to do that. I never encouraged him to go as far as you did. So kudos to you and bravo for doing that. But I wanted him to do a bunch of upgrades. It never actually happened. He ultimately sold it to you and you were the one that capitalized on all that. So again, bravo to you. But who helps you visualize this stuff? Is it just you walk into a place and it's your brain, or do you sit back down with your wife afterwards with the floor plan and go, what do we do? How do we make it look as nice as as you're making them?
Yeah. So I would say it's twofold. My wife is very involved with everything. She, I have 3 children, just under 3 now. So time has been difficult for her. She manages that household, allows me to do a lot of stuff. So she would do all of our design for renovations, particularly on single family. As we've gravitated to multifamily, I do a majority of the design. I've used a couple groups like Chelsea Garber. She does ROI by design. She's done a couple of our like exterior renderings. But usually I go into them like I don't do a lot of things well, but I can tell you what a value will be when I'm done, and I can see it very vividly, regardless of current condition, almost to a fault. Like we'll walk properties and my wife's with me, and then she's like, did you see this? Did you see this? And I don't see any of it. All I see is like what I know it's going to be. So it's almost to a detriment. I think it's served me well.
Yeah.
So like Boston, I sat in there and I just went back and forth. And then I analyzed it. Okay, like what, and then it just kind of came together. And I was like, this is the way it has to be done. And then the moment I made that decision, there was like no questioning it. Like, I'm not going to go back and say, okay, what if? It's like, it's done. This makes the most sense. I'm making the best strategic decision. I know exactly what the design's going to be. And then I pursue it. So I'd say most of the multis I do. Yeah.
It's funny you mentioned Chelsea. How did you meet Chelsea for the first time?
I met her through Mike Marrara with Capstone, right? So I'd worked with Mike. He had sent me a couple of these opportunities, and then I think he was sending me a couple of listings. One of them we didn't pursue, but she had performed some of the work on that.
Mm-hmm.
And my biggest thing was I love the design side, so I didn't feel like I necessarily would need that. But what was awesome about it is, so my intention and the value of it was actually, and you know this, like when I'm bringing it to an appraiser or a bank and saying, hey, I know this looks ugly now, but this is going to be a sexy asset when I'm done. Trust me, bro. It's harder. Like,
let me show you some of the other projects I've done. You'll see. Yeah. You'll have the vision.
Well, and that it's funny because now that I have the scale, and like we're doing that 7th Street 14 unit, I'm like, hey, look at Black Oaks. It's a block away. Look at White Oaks. But before you have that, it's like, hey, yeah, I've done some houses, man. Trust me. Like I put granite and stuff. It's like, so I actually I worked with her on a couple and said, hey, here's my vision. Here's the kind of theme. Like I want to put this in a more professional presentation to be able to distinguish to them. So it was really, that was the intent. And then ultimately, like she came back exactly with like what our model, like what I wanted it to be, but even added some other things into it. So there was additional value just from that perspective. So I think, that's how I started. She's done, I think 2 or 3 of those.
Can I tell you a funny story about Chelsea?
Yeah.
Her family's business is textiles, distribution of textiles. So I've known Chelsea.
Okay.
I haven't known Chelsea that long, probably since 2017. But she's been working, I guess, Garber Tex, which was her mom's business that she's now running. I guess she runs a bunch of different businesses because she's an incredibly capable person. But her mom's business and my wife's family business, Fabrica, which is here in Tulsa and has been here since 59 or something, she's always been a distributor of that product, of all the Fabrica lines, which is, I don't know, S. Harris and Vervain and a bunch of other products in the interior design textile world. So, Chelsea came to me. Chelsea, I think, originally found Tulsa because she was coming here, as in her role as a distributor for Fabrica. And as I love that so many more people are coming to Tulsa, but she's an OG in that she's been coming forever. And then she started getting involved. She was doing design work, and then she stared getting into multifamily. So I love just the nature of like the full circle Tulsa connection. It's just so funny. I mean, Chelsea's been at the house, has been at our house plenty of times to have cocktails and dinner and whatever else. And I then she started getting into multifamily, and she owns some stuff in Oklahoma City with in various syndications and partnerships. So fun. When you mentioned her name, it was just a fun stroll down memory lane.
Absolutely.
What do you say? Like you scaled into multifamily when you had 4 or 5 properties. What do you say to other people that are in that? It's like a tween phase. It's like in between. You've got enough. You might be cash flowing $200, $300, $400, $500 a piece. That's $2,500 of passive income a month. I mean, how do you what are the lessons that you learned from that point, from 4 to 5 houses to jump to the next level to where you are now, that other investors can learn from?
Yeah. No, I think, going through, to me, there are some investors that, you'll see scenarios where they jump straight into multi. And I feel like, hey, if you can do that, certain people have a temperament for that. I think for me, I do believe fundamentally like the single family model. Again, there's some overlap. It's not completely the same, but it's the least riskiest way to learn.
Right.
And to me, it's the most forgiving asset class and tranche. So, I learned so much about the renovation side, managing a rental. Like I learned the good and the bad and the ugly, right? So I think there was still a learning curve when we acquired our first multi, but that exposure to those other things set me up so well. That between stage is difficult though. And that's what Sam and I had consistently talked about before we started pushing stuff together, which was like it the better you get at it, and it's a great model, it's actually it's you start to become really comfortable with it. And you can, I mean, there's people that just have single family portfolios, right? So there's no, to me, that's not an issue at all. It was just scalability for me. But I actually started to get so comfortable with the houses that I knew it was time to I knew it was time for the next evolution because I was comfortable.
Right.
So I think the between stage is hard though. I think you look at the goals, like, again, I go back to the same philosophies of like, I only buy in certain areas because I have a quality level. That's the type of property that I like. So I think that that's important. And I also think it's important to where your overall destination is. So I knew that I wanted to scale to $100 million real estate portfolio. Well, it's going to take a lot of damn singles to get there. So I knew that multifamily made sense as a gravitation for the scale side of that. So, but that between stage is hard. But I think if you have enough traction, you've started to build some equity in the single family, it does make it an easier transition.
Did you find that your contractors that were doing the work on the single family houses were able to scale and just kind of transition through to the multifamily space with you?
To a degree. I think there's several of them that we've worked with for years that translate well, but it also required, layering in some additional, subcontractors that had more familiarity. I mean, to me, at a high level, like if you break down the single family or the multifamily, it's really just, yes, there's some common components, but overall, it's almost like you're looking at multiple smaller houses, right? Like you've got the exterior common area component. Okay, you can knock that out. Then we approach each one. And then to me, it's actually easier because each time we go into, when I was doing more houses, I was heavy in like Brady and Pearl, right?
Right.
We go into a house where it's like we're completely reconfiguring everything. Well, when I go into a multifamily, it's like once I figure out the exact layout, that's typically replicable, right? So it actually made it easier versus doing 10 houses with different floor plans, styles, areas. I actually think it was an easier translation because then we can just replicate that. So one of the things we had to pivot with contractors was, like if I have a guy that can do multiple things, that's great for a house, but can we do it in an efficient way when we have 14, right? Because it's going to take him a lot longer. So I've got to have some, so I had to translate some subs in terms of just the scale of it.
Do you think that multifamily is as profitable as single family in terms of general operating, or is it that you're taking a lower margin, but you've replicated it so many times that the absolute profit at the end of the month or year is greater?
Yeah, that'd be a interesting study, right? I would say at face that looking at pure quantitative, because you can always sell a single family to an owner occupant, right? I would argue that like 100 houses versus 100 unit or 250 units is more profitable. Now, where I think that pivots, and you have to consider that, is the opportunity cost, right? There's a hell of a lot more time to acquire 100 houses with 100 sets of taxes, with 100 different designs, with 100 different insurance policies, right? Versus multifamily. So I would say at face, without the opportunity cost facet in there, without quantifying that, I would argue that a single family portfolio's, there's more value in it. But I think with the scale side and the opportunity cost, which is vital, when we're busy, I think it's multifamily.
So you talk about the scale component of the multifamily in terms of paying one tax bill and in terms of paying one insurance policy, et cetera. A lot of people talk about it on the front end where they say acquiring a 20 unit multifamily unit is better than acquiring 20 single family houses because it's not a 20x multiple of the work involved on the front end. Is that, they say there's one roof. They say there's, instead of 20 roofs, there's, potentially one or two hot water tanks instead of 20 hot water tanks, et cetera. So that's the, I guess, the rationale that a lot of people use in terms of going into multifamily. And they say, I'd rather spend my time doing, 4x the work instead of 20x the work. That is the comparison of a 20 unit multifamily versus a 20 single family residences. But also it comes with greater risk.
Yeah.
At some level, it's not 20 roofs, but it could be, it could be 15 times the or maybe not 15, but 10 times the actual number of squares on the roof. So it's not like you're buying, it's not like you're buying one roof. You're buying a roof that is massively bigger. And so replacing that roof in a situation where you have to is massively more expensive. So you have to have more reserves or whatever else, right? I mean, it also is, one tenant that lights the building on fire means you have 20 times the headaches rather than one family that lights the house on fire and you're kind of dealing with replacing one family's home or whatever. Any thoughts on that as people scale into multifamily and use that rationale to do it?
No, I completely agree with that. And to me, it's not like you alluded to. I can make the case that if there's common walls, like if somebody wants to be a jerk and burn a house down, okay, I lose that house, right? But now I don't have the ancillary effect of all the other units, right? You do have that with multi. So to me, like if I'm just comparing 20 unit versus 20 houses, and I'm not considering time, effort, energy, I think that the single family is technically a more profitable and risk averse model. However, I think that in the same time it takes you to buy 20, you could buy 2 to 3 multifamily because of that opportunity cost. And that's something that I consistently think about of my time, right? Especially as I have children, you grow. It's like, to me, that's the value of it. It's like, you can't really compare them on 20 versus 20. It's really like, well, in that same time, I've got the scale to do 3 of those. So I can go 60 versus 20. Yeah. Right. So I think that's the key, but I think they're both great models. And I think as long as you're doing something and pushing in that direction, and then you have there's an openness to learning, that's the key.
Yeah. I mean, it seems to me that people often believe that the logical progression is you do a couple of single family residences, you learn everything, as you said, and then you naturally jump into multifamily. And I've always said, if that opportunity arises, that's probably a good model, but it's harder to find those deals. So if the opportunity doesn't arise and you just build a portfolio of 50 single families, that's also a good strategy. You shouldn't, you shouldn't, push this model away because, you're always focusing on that model. Rather do both at the same time. And it's hugely dependent on whether you have a full-time job or not. If you're just a pure real estate investor spending all of your time doing it, then you're going to grab any opportunity that comes. I don't think you should preclude or prevent one thing from entering your mind because you're solely focused on the other, or vice versa. So I think that's a good example from your side. You had a full-time job, so your ability to both have the capital to do the deals, have the W-2 to do the deals, and and the desire to do them efficiently because you are focused for 40 hours or so on something else is a really good rationale for actually jumping in multifamily. I don't think everybody always thinks of it like that.
Yeah.
Cain, what are you listening to? What are you reading? What are you doing to sharpen your pencil, so to speak, on a daily, weekly, monthly basis? I know you've got 3 kids. With 3 kids, I also have 3 kids, and they're 3 and a quarter, all 3 and a quarter or under. So difficult to find the time. But what are you doing to keep your pencil sharp?
Man, I think I used to just be so focused on pure, technical real estate, listening to every real estate podcast, and I have an obsessive nature to where, I was so fixated on that for so long that I've actually, I've kind of focused more on guys like Ed Milet. I'll listen to podcasts with them. I try to attend, they're still business related, but maybe not specific to real estate. I'll still catch some of those at some points, podcasts, things like that. But I really try to focus more on just overall, with people that have really scaled, like the Milets, people like that. I listen to the PVD sometime. To me, it's just I think so much of this is we can talk technical application all day long, but it's the psychology and the mentality behind it that I think is 75% of the success. So to me, as I've continued to grow and those things become harder and balance is a struggle, and having these aspirations but wanting to be intentional in my personal life as well, I think I put a lot of focus on those type of things that I still think help me long term, but I've kind of, as I've gotten older, gravitated a little bit away from just the consistent technical application of, those type of podcasts and stuff.
I mean, I think it's worth mentioning again that, the old quote, there's no amount of success that can compensate for the failure in the home. You can build it all. And if you're not doing it right in the home, taking care of your family and spending the time that you need to build good progeny, so to speak, then it's all for naught.
Yeah.
So I'm glad you mentioned that part. Tell us about PBD. Who's PBD? What is PBD? I've never heard that before.
So it is, man, I've only started listening to it recently. It's I heard this guy, what is his name? Man, I can't think of his name, but it's got
podcast. Let me just look real quick. Patrick Bet David.
He's an interesting guy. Yeah. So I had actually saw a couple interviews. So my guilty pleasure is I love like the old like white collar mafia moral code. Like Godfather was my favorite movie ever. I wanted to be Don Corleone. Like I love. So actually there's a lot of business application in it.
I bet.
Despite criminal activity, right? But I've always been infatuated with that. So I noticed him because he had interviewed a couple like former mafia type people, and then he has this kind of, he's a business, entrepreneur, very successful. He had been on a couple of different shows with like Milet, a couple of guys like that I really liked, and so I've listened to a few of his, and they'll go off onto different kind of tangents, have different people on. It's just more of a broad array. But I got to that point where I just don't focus as much. Like I'm dealing with technical application every day on our own projects. So if I have questions of, okay, what about a rub system? What about, my profit margin? Like I'll listen to stuff that helps me with that, but I'm dealing with it so much that I really feel like I like to go higher level, maintaining, focusing on the discipline aspects, the mentality, the balance, how to continue to achieve these, ambitious goals and aspirations, but also, be intentional at home. Like, I feel like that's kind of been some of my shift in probably the last 3 or 4 years.
Just taking higher level concepts from various businesses and then tailoring the applicability to real estate. I love it.
That's it.
Cain Wright's a multifamily and single family investor based in Tulsa. He owns with his group, Wright Property Group, and others about 100 doors. I shouldn't say single family. That's a gross misrepresentation. They renovate properties and reposition them. They do beautiful work. Check out Black Oaks, White Oaks, the Bostonian. They've done some really, really nice stuff. Cain, if people want to reach out to you and sell you a property that you can renovate and reposition, how do they reach you?
Yeah, I mean, so we don't have a dedicated website. I mean, we push all the properties through, like the various rental channels. But I'd say, my wife deals with the social media side. I'm ignorant to all of it, but she's great about it. So you can look at Wright Property Group on Instagram or Facebook. We try to stay, up to date, posting new projects, things that we have going. So that's easy to reach me through that way. It has my information, contact, email, everything.
Cool. I love it. Cain, thanks for being on the show. Appreciate you so much.
Yeah. Thank you, man.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.